Welcome to your daily market briefing. Here are the key headlines shaping today's markets. 1. U.S. retail sales miss reprices Fed path, yields drop across curve. 2. Takaichi supermajority sends Nikkei to record, reshapes Japan policy outlook. 3. China directs banks to limit US Treasury exposure, DXY weakens. After the headlines, you'll find a global market snapshot and a forward calendar of what to watch. Before we turn to today's stories, a short introduction. Daily market briefing. Think ahead, every market day. Subscribe to stay focused on what matters. Please keep in mind that all content in this video is for educational purposes only. It provides market context, not financial advice. 1. U.S. retail sales miss reprices Fed path. Yields drop across curve. Primary asset classes impacted. U.S. Treasuries, 2Y, 10Y, 30Y. U.S. equities, S&P 500, Russell 2000. DXY, Fed funds futures, gold. What happened? U.S. retail sales were flat in December, missing consensus of plus 0.4% MOM. The control group fell 0.1%. Treasury yields dropped sharply, with the 10-year falling 6 basis points to 4.16%. Markets repriced Fed rate expectations, now pricing 325 basis point cuts in 2026, up from 2 previously. Why it matters? Flat retail sales challenge the narrative of a resilient U.S. consumer. The miss reopens the door for earlier Fed easing, compressing rate vol and pulling front-end yields lower. Softer demand data, combined with cooling employment costs reported the same day, shifts the balance of risks toward growth disappointment. If confirmed by this week's NFP and CPI, the repricing in rates could accelerate, weakening DXY and supporting duration-sensitive assets globally. Key numbers to remember. U.S. 10-year yield fell 6 basis points to 4.16%. 30-year fell 7 basis points to 4.78%. DXY dropped below 97 for the first time since early 2022. Fed funds futures now price 325 basis point cuts in 2026 versus 2 prior. What to watch next? Delayed. January NFP report releases Wednesday. Consensus expects approximately 70,000. January CPI follows Friday, with core MOM at plus 0.2% expected. A weak payrolls print would cement the 3-cut narrative, steepening the curve and pressuring DXY further. A hot CPI would reintroduce two-way risk to rates. The sequencing of these 2 prints within 48 hours creates a high volatility window for UST, FX, and equity index positioning. 2. Takaichi supermajority sends Nikkei to record, reshapes Japan policy outlook. Primary asset classes impacted. Japanese equities, Nikkei 225 Topics, JGB 10Y, USD/JPY, BOJ rate expectations. What happened? PM. Takaichi's LDP won 316 seats, securing a 2/3 supermajority in Japan's lower house. The Nikkei 225 surged 2.28% to a record 57,651. JGB 10Y yields reversed Monday's spike, falling 5 basis points to 2.24% as markets reassessed fiscal risk. USD/JPY traded near 155.70. Why it matters. Takaichi's supermajority clears the path for aggressive fiscal expansion, a 2-year food sales tax suspension, higher defense spending, and infrastructure investment. The initial JGB sell-off reversed as markets interpreted the mandate as reducing political uncertainty rather than amplifying deficit risk. The yen remains under structural pressure from widening rate differentials and expected fiscal loosening. The Bank of Japan faces a more complex policy calculus, balancing rising inflation against the government's growth-first agenda. Key numbers to remember. Nikkei 225 closed at an all-time high of 57,651, up 2.28%. JGB 10Y yield fell 5 basis points to 2.24% after Monday's spike. LDP won 316 of 465 seats, the largest mandate in a generation. What to watch next? Japan, Q4, GDP is due next week. Consensus expects a rebound from Q3's contraction. Any upside surprise combined with Takaichi's fiscal pledges could reignite JGB selling pressure and push 10Y yields back above 2.30%. Watch USD/JPY around 156 to 160, where intervention risk rises. BOJ March meeting expectations may shift depending on how quickly fiscal plans translate into spending commitments. 3. China directs banks to limit US Treasury exposure, DXY weakens. Primary asset classes impacted: US Treasuries, long end, DXY, USD/CNH, gold, EMFX. What happened? China's financial regulators urged commercial banks to limit holdings of US Treasury securities, citing market volatility concerns. The directive targets bank balance sheets rather than official state reserves. The move adds to broader de-dollarization signals and coincided with DXY dropping below 97 for the first time since early 2022. Why it matters? While the directive applies to commercial banks rather than PBOC reserves, it signals a strategic shift in China's approach to USD-denominated assets. Combined with ongoing reserve diversification into gold, this reinforces structural headwinds for the dollar. The timing, alongside soft US data and a weakening DXY, amplifies the market narrative of eroding USD reserve demand. If official reserves follow a similar path, it could widen term premia on the long end of the UST curve. Key numbers to remember. USD/CNH fell below 6.92 to a 33-month low. DXY closed at 96.79, its lowest level since Q1 2022. Gold breached $5,050 for the first time, reinforcing the diversification theme. What to watch next? Monitor PBOC gold purchases data and TIC flow reports for confirmation of broader diversification trends. Watch whether other EM central banks signal similar adjustments. USD/CNH broke below 6.92, nearing multi-year lows. Any escalation of US-China trade frictions could accelerate the shift. Near term, the directive's impact. This global market snapshot is designed for quick reference. You may pause the video to examine the data more closely. This forward calendar section is designed for quick reference. You may pause the video to examine the data more closely. Thank you for watching today's briefing. In markets, understanding the field matters as much as making the move. And that's the perspective we aim to provide. Subscribe to Daily Market Briefing and turn on notifications to stay focused on what matters every market day.